Our next guest is Brian Belsky, Chief Investment Strategist at BMO Capital Markets. He is back with us to give us his outlook on the capital markets, the economy, and stocks. Brian, welcome back. Always a pleasure to have you.
Thank you so much for having us. It's always great to be on with you.
You made the rounds on the internet last time you were on a couple of months ago by being probably the most bullish guest we've had about stocks. And I'd love to get your take. You've had a lot of different viewpoints around your video. I'd love to get an update. The major change that I've noticed in the markets is the rise in yield since a few months ago. I've had some guests call it a parabolic rise upwards. What's your take on this? Has it affected your outlook at all?
Well, I don't know who those guests were, but from a parabolic side of things, when you're coming from 0 to 1.5 or 1.6 or whatever, maybe the rate of change has been a large change in terms of just the pure percentage. But that's when you have to kind of take 2 steps back, David, and apply some perspective. If you include the financial crisis, the average 10-year treasury since 1950 is 6.3%. If you take out the financial crisis, it's 5.7%. So, ladies and gentlemen, take a deep breath. When interest rates rise from excessively low levels, which obviously we were at, that means the economy is improving. If the economy is improving, companies are generating earnings. If companies are generating earnings, stock prices are going up. So what's the equation of investing, David? Stocks lead earnings, which lead the economy. Mm-hmm. And that's exactly what we've seen. People need to take a deep breath. I think the problem that I've encountered is the I like to call it the OCD market. We have obsessive compulsive disorder on particular topics. Right now it's inflation. Inflation, here comes inflation. And this is my 31st year on Wall Street, so I missed the early 80s as part of this, but we've been looking for inflation in the United States, and for the world for that matter, but especially the United States since 1982. And so this notion of inflation's coming tomorrow and today is so short-term oriented. Clearly, we are going to see some inflation pressures, and we've seen some numbers with respect to PPI, meaning the producer price index, and that means earnings power and pricing power for companies.
Yeah.
But it's not green light go. Just because we're starting to see a little bit higher prices does not necessarily mean that we are in an inflationary environment. And that's why the Fed has been so steadfast in terms of what they're thinking and why they're thinking. So let's just all take a deep breath. Let's stop being reactionary. Let's stop making these daily and weekly calls on what kind of environment we're in.
Yeah. Well, if I remember correctly, that in the 70s, which the environment that led to the high inflationary environment in the 80s was the OPEC oil crisis. We had a supply crunch in energy, which led to a stagflationary environment. Now, I think some people are concerned today that we might be seeing something similar. Well, not from an energy side, but we had a supply crunch issue during COVID when the supply chain broke down. And that's part of the reason why some people are afraid of inflation. Do you see any merit in that argument?
No, we don't, because I think there's plenty of supply of oil, right? And if you take a look at why emerging markets have rallied because, for the most part, because of the weakness in the dollar. Typically and historically, you don't want to buy assets based on currency. You want to buy assets based on underlying fundamentals. There's plenty of oil, plenty of supply. And remember, we were coming off of depressed levels. You were trying to sell, oil was negative a year ago, mm-hmm. right? So we've forgotten about that already. And now we're off and running that we're in the next great commodity super cycle. I think that's short-sighted. I do think that global synchronized growth has improved, but we're not on a early 2000s trajectory in terms of commodities. Going back to your 70s comment, I think it's, again, short-sighted to only be focused on commodities. Now, I remember the 70s. There's a classic photo of me, David, on a mini bike in line getting gas.
I'm not going to ask you to share this photo. I'll just take your word for it.
No. But here's where I'm going with this. People forget, okay, that one of the largest increases with respect to debt to GDP in the history of the United States was during the John F. Kennedy administration. And many people talk about that was NASA. That was NASA. Actually, it was a buildup of the Vietnam War. And so then you had President Nixon coming in and trying to get the ship right in terms of taxes and spending. And then we all know what happened to President Nixon. But in the 70s, we were still dealing with the unwind of the Vietnam War. And that actually caused a lot of what was going on with respect to inflation. It wasn't just the oil embargo. It's not that simple. So again, this is about perspective. And I think too many people default to the negative. And that's where exactly we were last year. And let me go back to this OCD comment, obsessive compulsive disorder. We were obsessively compulsive and disordered, by the way, on some of the macro projections a year ago today that the world was going into the next Great Depression. David, do you remember that? How'd that go? And so I think anytime we, meaning the marketplace, is usually one-sided on a topic, like we were a year ago that we're going into the next Great Depression. I think the same kind of rule can be applied on this over-focus on inflation right now.
I have one last question about inflation, and we'll move on to the markets. Now, a common argument I've heard for inflation is that due to unprecedented monetary stimulus and the expansion of the Federal Reserve balance sheet to unprecedented levels, that ultimately will lead to an increase in the money supply, which by definition will lead to inflation. Historically, we've seen that in the past with what people like to cite the Weimar Republic in Germany in the 30s. What's your take on that?
Okay, so again, do your history, right? So in your business school books, in your fancy schools, you probably remember the little girl with the wheelbarrow full of German marks buying a loaf of bread. The Weimar Republic and what happened in terms of the devaluation of the German mark was about paying reparations after World War I, and led to what happened going forward in terms of the more nationalism state that we saw in Germany. But people have to go back and do their history. And part of that was because of what Woodrow Wilson did post World War II and putting the League of Nations together and enforcing those war reparations. And so we had this, remember too, we had the pandemic and all of that. So again, it's not as simple as that. And I would say this on the money supply, we're still waiting for money supply to get going. And I think blaming stimulus or applying stimulus is the reason why stocks went up. Stocks went up because they're the best assets in the world. And that's why they went up. And we believe too that even in March of last year, when we made the call that we believe the second half of our 20-year bull market began on March 23rd, that was the Control-Alt-Delete. We reset the next 10 years. We're in print on that. It was a public report. So I know a lot of people claim they made the call. We made the call in print on that day. I think a lot of people didn't agree with us because it was all about chasing the money. Well, it was about chasing the best asset, David. And the best asset, we believe, still a year later, are U.S. and Canadian stocks. Okay.
All right, let's go back to interest rates for a sec. I've heard the argument that with the rise in nominal yields, that will bring down the valuations of some of the growth sectors like tech stocks, which are valued using a 0% risk-free rate. And of course, if you raise that, it'll bring down their valuations. What's your response to that?
Well, you're probably talking to fixed income people that shouldn't be talking about how to value stocks, right? I mean, that's my simple response to that. If you're using a zero interest rate in terms of your risk-free rate, I think that's too aggressive because obviously that was very short-sighted. We weren't going to be at zero interest rate. And if you're doing a discounted cash flow model or a dividend discount model, you're looking forward. We're not going to be at 0% a year, 2, 3 years from now. So I think that knowledge and that is a fallacy. Let's say that, number one. Number two, I think to make blanket discussions in terms of tech doesn't make sense to me because if you take a look at the cash balances of companies like the Amazon machine or the Apple machine or the Microsoft machine, are much different than, let's say, Tesla or even Bitcoin. And so I think on an individual basis, rising yields are going to have an effect on some of the high-flying stocks. But the high-flying stocks, actually, if you take a look at what has happened year to date in terms of the Mufangs, if you want to call them, dramatically underperforming. So guess what? Part of that's already happened. but they're not the major force in terms of where valuations are stretched. The major force of where valuations are stretched, so let's just pick on the poster child, Tesla would be the better example of that.
Okay, Bryce, are you saying that in your discounted cash flow models for the stocks that you work on, are you not adjusting the discount rate for higher interest rates at all? Is that something that you've considered?
Well, let me be clear. We are, I think, one of the only strategists in the world that run real live money. So I run $5 billion in Canadian money. That's a mixture of US and Canadian money in Canada, and close to $2 billion in the United States. We don't build individual discount models on every single stock that we own. We rely on our great analysts at BMO and our other resources to run the money and manage the companies in the portfolios that we do. With respect to building our discounted cash flow models and dividend discount models on the entire stock markets of both Canada and the United States, we never had a zero risk-free rate. The risk-free rate that we applied was higher because that's common sense, and that's analysis going forward that the risk-free rate was going to be higher. So anyone that had a zero risk-free rate on markets, on a market model, even if they actually, the people you're talking to, maintained a model and published a model and had a track record of a model, I think that those are all different conversations.
I'd like to bring up a key point you just mentioned, which is that forward-looking, the risk-free rate should be higher. Here's an argument I've heard recently that I found was pretty interesting, which is that, yes, you're right. Historically, if you look at the longer-term history, the 10-year yield should be at 5-6%. That's actually quite normal for that to be the case. But right now, given the excessively high debt levels that the U.S. government has just accumulated over the last year, close to $30 trillion in total debt, the government cannot afford for interest rates to go back to historically high levels of 5-6%, because then the interest expense alone would bankrupt the Treasury. It'll be in the order of trillions, which is a high percentage of the tax revenue that the country brings in. Do you agree with that?
Well, I think that's why you're not going to see that. Well, first of all, to keep it simple, the Fed's going to maintain its bias. Number one. Number two, we're not going back to 5 to 6% for several years, if not several decades. We know that. Number three, we've been deficit spending in this country for several decades, so the numbers are getting big, and I think people like to throw out the number, but on a percentage basis, obviously coming out from this unprecedented time, which I don't think should be looked at as a recession. It should be looked at as a natural disaster. And we're still going to be dealing with this for several years. It's something that we wrote about in our year ahead piece for 2021 in terms of the return to normalcy is going to be a process. It's not going to be a single year event. So okay. This is going to hold down returns, but it also is going to hold down interest rates.
Okay, let's bring it back to equities now and talk about your positioning. Can you give us a brief overview of your overweights and underweights right now?
Sure. The way that we look at how we position in both the U.S. and Canada from a sectoral basis is we look at over the next 12 to 18 months, and that's why we favor financials, consumer discretionary, industrials, and materials in both countries. In the U.S., it's a little different on the makeup of the sectors. Clearly, when you combine communication services and technology, it's 40% of the market, David. So we're maintaining those positions. We're telling people to not sell tech. In fact, you should be buying your Apple and your Microsoft and your Amazon and your Google and your Netflix on these big down days that you had last week, because then you all of a sudden have these reactionary days to the upside that we've seen. So maintaining positions in tech, I think, is going to be a very important thing. And again, tech isn't painted with one brush, David. Apple's very different than NVIDIA. Apple's very different than Peloton. Apple's very different than Tesla. So this is why we are advocating a bottoms-up stock picking active approach to portfolio management. Not about index management, but this is about owning the right stocks in the right industries and the right themes in the right sectors.
Okay, and let's talk about the best performing, I know what you're about to say, but the best performing asset class of 2021, which is Bitcoin. I'm quoting another bank here that they've released, Goldman Sachs, they just released a chart recently, and it made the rounds on the crypto community because it's the first time that Goldman has included Bitcoin along with the S&P 500, other indices, gold, commodities. So they've considered it an asset like any others. So anyway, according to this chart, the crypto space, Bitcoin in particular, has been the best performing asset of 2021 so far. What's your view on this? And do you look at cryptocurrencies in your analysis?
See, all you're trying to do is increase the hits on YouTube with respect to, because here we go, Belsky's going to talk about Bitcoin. So listen, I don't think that Bitcoin's an asset. I think Bitcoin's an instrument, and nor do I believe that Bitcoin should be part of your asset allocation model. I don't typically comment on other people's research because I was not part of the process, and I think it's not apropos to do that. So congratulations, Goldman Sachs, for your report. But I would say this: anytime you sign up for an account, David, it tells you be prepared to lose money. And I think that's what has been lost this year with all the GameStop stuff and the individual trading and having your own account. It just made it clear that you need a financial management professional to run your money. And every time, again, you sign up for an account, it says there is risk of losing money. The way that we would play the Bitcoin thing is create a separate account that is out of your asset allocation sleeve and say, put some money in there that, hey, if it goes up, great. If it goes down, great. It's not going to hurt me. And so it remains to be seen whether or not Bitcoin is an asset. I think some of these comments and new products are about because Bitcoin has gone up. What happened in 2017, 2018 when there was no demand for Bitcoin and lots of supply? Well, guess what? The price went down. And so I think we have to be a little bit leery with respect to defining it as an asset. And I think that remains to be seen. I think the best assets in the world are things that you can actually reach out and touch and use as part of your everyday life. And that's kind of the Peter Lynch, Warren Buffett way of investing. And that's what we've been living off of for over 30 years.
Would you ever at some point in the future change your definition in regards to Bitcoin if it becomes something like that? Well, it's not going to be physical and tangible, but if it becomes sort of a means of payment or it becomes more ingrained in our everyday life? If, I'm not saying it will, but if.
Well, there's this whole saying, you can teach an old dog new tricks. And for the record, I didn't like Netflix at first, and I love Netflix now. I just didn't understand the whole model in terms of getting a DVD in the mail and signing up for that. But then I understood the scalable part of it when it was a platform with respect to having it on your iPad, for instance, and clicking on and getting movies. So, Netflix has become the Kleenex of streaming. And so does Bitcoin have an opportunity to do that? I don't know. Can you you need to be adaptable in this world. So I'm open to it, but I have to learn more about it. And this whole notion is if everyone's talking about something, David, I like to go the other way.
All right. Commodities now. Gold has been the worst performing asset, according to this chart that I cited. What's your take on commodities? Well, commodities, it's a very broad index. I use gold as just one commodity, but your view on commodities is a complex.
CRB Metal Index has suffered a little bit more relative to where it was certainly last year. I think certainly last year we were talking about much more dollar weakness and what's going on in emerging markets with respect to currencies. I still think gold should be a part of your portfolio, actually, and that is a hard asset. And so we do like gold from a longer term perspective. And, the gold is one of those areas that you want to buy when nobody likes it and you want to try to get out when everybody loves it. And that certainly is an emotional type rhetoric driven story in Canada. And so we would maintain our gold position. And in fact, I think there's a very good chance that if and when we see a stimulus package and another stimulus package in the United States, we could see interest rates kind of go down. And I think that could actually, and no one's saying that. I think you could actually build a case for having gold as part of your portfolio. And I think part of it too, David, is this maybe belief that, Bitcoin is an asset class, and you've seen some redistribution with respect to literal money out of gold and into Bitcoin. I don't necessarily agree with that. But again, gold is that hard asset that I am more comfortable with holding.
All right, Brian, I appreciate your candor and your update as always. Thank you very much for being on the show.
Thank you.
And thank you. Thank you for watching Kitco News. We'll be back. Stay tuned for more coverage.